Good afternoon. Shares in Asia declined following losses overnight that saw the Dow Jones notching its first decline in 2022. In Japan, the Nikkei slipped 2.6%, and in Hong Kong, the Hang Seng Index shed 0.3%. Hong Kong's listed shares of debt-ridden developer China Evergrande Group fell 0.6%. Reuters reported that the firm will seek a 6-month delay in making payments on an onshore bond. Meanwhile, in the U.S., stock futures were muted in early morning trading. Minutes from the Federal Reserve's December meeting revealed that the central bank discussed reducing its balance sheet in another move to aggressively dial back its pandemic-era easy monetary policy. The Fed's plan to reduce the number of treasuries and mortgage-backed securities it holds comes as it's already tapering its bond purchases and is set to hike interest rates after the taper concludes. To talk to us about how the market is reacting to a whole host of this information coming through, we are joined by Lukman Otonuga, who is from FXTM. Lukman, thank you so much for your time. I mean, when you take into consideration what's happened with the FOMC minutes we were waiting for, is it too late for me to buckle up at this particular point to fasten my seatbelts, or can I still do that right now?
Thank you very much for having me here, Anastasia. It's a pleasure. We're only a few days into the new trading year and so much has happened. I believe there's going to be so much volatility on the cards, so it's not too late for you to fasten up your seatbelts because the next few weeks, months are going to be something to remember.
Right. On that note, then, I mean, when you look at the FOMC minutes, does it give you confidence that the Fed will be able to do what it intends to do? Or is it a case where, you know, they might not be able to maneuver that soft landing that we've been talking about? They might just, you know, it might hurt the markets a little bit.
Yeah, certainly. If we looked at the market reaction from the hawkish minutes and the fact that the Fed was more aggressive than most expected in regards to raising interest rates. We saw the S&P 500, NASDAQ collapse like a house of cards. Negative sentiment rolled into Asian markets and likely going to dictate the mood for the rest of today. Even though the Federal Reserve has done what it can to slowly guide markets towards the path, you know, to inform them that they are going to tighten monetary policy over the next few months to years. And we can see that if you look at the exceptional gains witnessed across stock markets, this has been on the back of easy monetary policy. And there's a lot at hand right here. As the Fed starts to tighten, the dollar is going to appreciate. This is going to hit stock markets. Tightening financial conditions are going to hit emerging markets. We're going to see bond markets move higher. So it's going to be a tough call for the Fed this year to really guide markets. And I think as time goes on, it depends on their communication, how they're able to get the message across. But as I said, markets are clearly highly sensitive to Fed rate hike expectations at this moment.
Right. You mentioned Asia in your response, and I can't help but think of China. Do you expect China to be a wild card again this year when it comes to economic discussions or even market discussions?
Certainly, we saw how China hijacked the financial headlines last year. We had the Evergrande crisis, we had the issues of governance, rising debt and COVID-19. At this point in time, you know, when we saw that sparked explosive levels of volatility across markets. China's expected to actually expand anywhere from 6 to 8.5% in 2021, and growth is seen 5 to 6% in 6% in 2022. If we look at what's happening in China right now, I think while other countries across the world are moving towards tightening policy, China is trying to adopt a pro-growth policy. We saw the People's Bank of China, you know, pump more cash into the markets last year. At the same time, lower interest rates in the effort to stabilize growth in the face of all these domestic risks that are threatening the second largest economy in the world. Moving in 2022, though, I think they are going to remain a wild card. Given how we saw the events playing out in 2021, the fact that the Evergrande, the debt issues and COVID-19 still remain major domestic risks.
Yesterday, we were having a conversation around the Japanese yen, a weaker Japanese yen. And this morning, I had a look at the, you know, your dollar yen or even the dollar euro. What are your expectations for the dollar going into 2022? Do you still expect it to still rule the FX markets?
And that's the burning question. I find myself asking, will the dollar continue to flex its muscles across the G10 space? Well, it's ready and locked and loaded. The Federal Reserve has already signaled that they're on a path to raise interest rates 3 times in 2022, which may widen the interest rate differential between the dollar and other major currencies. At the same time, I believe as the US economy continues to improve, expectations continue to rise over the Fed, taking that move in the face of rising inflation. I think dollar bulls are going to continue ruling the scene. Already, Thursday, if you look at the dollar's performance across the board, is one of the best performing. It's appreciated against most G10 currencies and emerging market currencies. In the near term, though, when we're looking at the dollar's valuation, I think it's going to be heavily influenced by economic data and speculation around how fast the Fed is going to pull the trigger on higher rates.
Lukman, let's leave it there. Thank you so much for your time. That is Lukman Otonuga from FXTM Research. And he does mention in his morning note that all eyes now focusing on December's jobs report, which will be released tomorrow. Market will be scrutinizing to see any kind of insight when it comes to the health of the US labor market and, of course, wage growth.